This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, we're still on chapter, I don't know what chapter we're on, actually, chapter 7 I think it was, dealing with variance analysis. We've been through the marginal costs, so we've done material variances, labour variances, variable overhead variances, and analysed them. Two more sets left, and then we can put it all together. The first is the final cost variance, because of course there were fixed overheads, if you remember, and this couldn't be easier. Fixed overheads. We were using marginal costing, and of course fixed overheads should be fixed. And so the fact that we've produced more units here, whether it was more or less, shouldn't make any difference. Fixed overheads should stay fixed. And so for fixed overheads, we simply look at the expenditure variance. And the expenditure variance couldn't be easier, the most logical one of all. We compare the actual total expenditure, which was 134,074, with the budget total expenditure, which, where was it in the question, 130,500. And so we have overspent, and as always we want to know why, but we've overspent by 3,574. Because it's an overspend, less profit, it's adverse. So that one's easy. And we've now dealt with all the costs. One remaining thing, though, before we do summarise, I said, you've probably forgotten, but I did say right at the beginning of the variance example that ultimately we wanted to produce a summary for management explaining why the actual profit was different from budget profit. And although, oh dear, sorry, it's miles back, but if you remember, we originally budgeted on 45,500. We actually got a profit of 30,000, and I do want to shortly to produce a little statement explaining how why things were different. Now, part of the reason obviously were all these costs, and we've been through all of them. But the other reason, of course, relates to sales. I did say immediately that the most obvious reason of all, at a quick glance, why you expect different profit is because you sold more. If we sell more, obviously we expect more profit. And the other thing that affects us, of course, is even on our actual sales, we should have had 630,000 revenue. If the actual revenue is higher or lower because the selling price was different, then obviously that affects our profit as well. So the final thing we need to look at are the sales variances. And let's look at those two reasons separately. I said the first reason, well, it doesn't matter which you call first, but I said perhaps the most obvious reason for expecting different from original budget is because we sold more. We call this the sales volume variance. And I had actually written this down earlier without giving it a name. But the sales volume variance, we check to see, did we sell more or less? We compare our actual sales, which in units were how many? 8,400. With our budget sales. The original budget, we were budgeting on selling 8,000. So we've sold 400 more units. And if that's the only thing that changed, if everything else went perfectly, how much extra profit would that have given us? Well, remember we're doing marginal costing, and so every extra unit gives us more contribution. We cost out at standard contribution per unit, which, if you look back or look at the question we do to our heads, the standard selling price was 75. The standard marginal cost was 53. So the contribution 22 a unit. So if everything else had been perfect, that would give us extra profit of 8,800. It's favourable. Finally, what's the other thing that could have gone wrong? The selling price. We should have been selling units at a standard price of $75. If we sell at a higher or lower price, pretty obviously we get more or less revenue and therefore more or less profit. So the last one is the sales price variance. And to check whether we were selling at too high or too low a price, we take our actual sales. We actually sold 8,400. And we compare the actual revenue, so at actual selling price. Here they haven't told us the selling price per unit, but they have told us how much we sold them for in total. 613,200. And we compare it with how much we should have sold them for. Actual sales at standard selling price. So again, we sold 8,400. We should have sold them at 75 a unit. And so we should have got revenue of 630,000. So it should have been 630. We only got 613. We've obviously sold at a lower price. So how much has it lost us? The revenue is 16,800 lower than it should have been. And less revenue means less profit. It's adverse. So there we are. We've done all the variances. All that remains on this exercise is to produce something I referred to earlier. Let's produce a little statement explaining to management why the actual profit differs from the original budget profit. And so we've done all the work we need on this, but just let's put it all together. We'll produce this statement and we call it the operating statement. Now you can't be asked to prepare a full operating statement, but you are expected to know what it is. They can test if you know what this statement is. And we always start off with the original budget profit. And I'll try and avoid going up and down the screen, otherwise we'll be all over the place, you'll go dizzy. I'll try and remember, I'm looking at the question, the original budget profit 8,000, less the fixed overhead. The original budget profit, I can't remember, I'm sorry, so I will have to go up. 45,500. Why didn't we get 45,500? Because of all these variances we've now calculated. So first of all, most obvious one, the effect of sales. We have the sales volume variance. We've just calculated that, so I don't have to go back very far. Sales volume variance was 8,800 favourable. So that would have increased profit. We also had the sales price variance. Again, we've just had that 16,800 adverse. That would have reduced profit. We now list all the cost variances, and so here's where I'll do my best to remember them. Materials, there was a materials expenditure variance. Materials, 1634. I think that was 3867 adverse. We had a materials usage variance. The usage, materials usage was 612, I think, favourable. Labour, we had a rate of pay variance. The rate of pay variance was 2485, I think, favourable. There was idle time. That's an easy one. I could do it in my head, in fact. Idle time, 1300, 6500 adverse. And then efficiency variance. 2000 it was. 2000 favourable. Variable overheads. We had an expenditure variance of 852 adverse and an efficiency variance. Remember, it's the same as labour, but at $2 an hour instead of $5 an hour, so that was 800. Oh, wait a minute. Was it favourable or adverse? It was. Expenditure was favourable, sorry, and efficiency was favourable. And finally, we had the fixed overheads expenditure variance. An easy one, remember, just the difference between the two. So it was 3574 adverse. And the net of all of those, add and subtract the favourable, subtract the adverse, should give us our actual profit. So this could prove to be very embarrassing. Let's just check if it works. 45,500 plus 8,800 minus 16,800 minus 3,867 plus 612 plus 2,485 minus 6,500 plus 2,000 plus 852, 800 minus 3,574. I get 30,308. Let me wind up the screen one last time to check, was that right? 3308. Yes, it was. Excellent. All right, now, I said a moment ago, you can be asked to produce that statement, and you certainly wouldn't be asked to work out all the variances in one question, you know, to be selective. But you are expected to know what the statement is. So I hope that's pretty obvious. It's just reconciling, explaining why actual was different from budget. And that will be presented to management. And of course, although we've done all the numbers, management would want to get explanations from the relevant people as to why things were different than budget, particularly, of course, those that were adverse. So, materials and expenditure, I said there's probably a purchasing manager will want to know, why did we spend more than the £4.50 a kilo? Well, is there anything we can do to put that right for future months? Labour, we save money, great, but we'd still want to investigate. Are we going to carry on saving money in future months? Or was this just what you might call a one-off reason? And so, they've got the statement there, but they would want explanations from the managers as to why those things had happened, why the variances had occurred. And, as I've just said, in terms of adverse ones, can we correct them? Is there anything we can do to avoid them being adverse in the future? And do make sure you are able to discuss them, because you test on that just as easy as you can be tested on the numbers. If you just turn for a minute to exercise 4, and I'm jumping an exercise here, but exercise 4, it says in the previous example, so the one we've just done, there was a materials price variance. Same thing as materials expenditure, same thing. And it was 3867 adverse. And it says suggest possible reasons for its occurrence. Now think about it. One or two reasons might be obvious, but think what it means. The expenditure variance, I'm not concerned with whether we use too much or too little. That's nothing to do with it. All that's measuring is that the materials we bought, we should have paid £4.50 a kilo, and we clearly, since it's adverse, are paying more than £4.50. Why are we paying more? Well, I don't know why here. That's why it says suggest possible reasons. But let's see how many we can think of. I think the most obvious reason is that the price of materials increased. Prices go up. Maybe when I did the cost cards, it should have been £4.50. The suppliers put the price up. It's now £4.60, so we spend more. So that could be the reason. And of course, if prices go up, we can't really blame the purchasing manager. But what else? That's not the only possible reason. It could be that prices haven't gone up at all, but it was what I call, to keep it short, bad buying. What I mean is, it could be that the purchasing manager had perhaps gone to the wrong supplier who was charging more. So maybe we could have bought it for $4.50, but the supplier we went to was charging $4.60. Or maybe, again, what I call bad buying, maybe we should have been able to get a discount, but the purchasing manager didn't fight hard enough. We didn't get the discounts. Not got discount. It's possible. We don't, again, I don't know why here. We won't know why in the exam, but it's possible. Whereas in the first case, if price goes up, there's not much we can do about it. It's not the manager's fault. In the second case, of course, there is perhaps something we can do about it. Sack the manager, or train the manager, and maybe in future months, we will go to a cheaper supplier, or we will get the discounts. What else? Oh, now here's a good one. It could have been that the reason we paid more is that we deliberately decided to buy better material. We want better quality material, and obviously if you buy better quality material, it's likely to cost more. But why on earth should we decide to do that? Why get better material and pay more for it? There are two reasons you might consider it. It could be because if you've got better material, it could be then we can produce a better product. And of course, why produce a better product? We're not a charity. If you do produce a better product, then we can either increase the selling price, or maybe we can sell more units. Now, I don't think the first one has happened here. If this was the reason we paid more, because we bought better material, well, we certainly haven't managed to increase the selling price. If you look back, the sales price variance was adverse. So I rather doubt that's why we'd spent more. If that was the reason, then it's certainly not worked. Could be to sell more. Well, all right, here we have sold more. We've got a favourable sales volume variance. But I think that's more likely to have occurred because we dropped the price. I think it's unlikely it's because we bought better material. However, there's another reason why you might have decided to buy better material. Maybe if we have better material, we waste less. You know, at the moment, perhaps the original budgets, the material wasn't such good quality, so we had a lot of waste. Buy better material, maybe it's less waste. And of course, if there was less waste, what would happen then? We'd have a favourable usage variance. And here I think we have. Let me look back. Yeah, we've spent 386.7 too much on the material. Just suppose it was to buy better material, and as a result we wasted less. Fine, we've saved on the usage. It's favourable. Now, in fact, if that was the reason it wasn't worth doing, you see, had we saved more on usage than the extra expenditure, that would have been a good move. Here, if that had been the reason, it's not really worked. We've only saved 600, but we had to spend an extra 3,800. But that highlights the danger. We shouldn't just go down and say, oh, bad, good, good, bad, good, you know. They can relate together. If we were buying better material, it would be important to look at those two together if it was better material in order to hopefully waste less. Or I can think of another reason actually. We bought better material. Or I say, sorry, that may have been the reason for spending more. But maybe it's so that we can work faster. You know, maybe it's wood and it's poor quality and it takes a lot of time to cut the wood. But by buying better wood, maybe the workers can work on it faster. And if that's the case, you'd save money on the efficiency. So again, it's dangerous to look at one on its own. Spending more on material looks bad. But if as a result you saved more on efficiency, then it would have been a good move. But I'll write it down for completeness. Faster working. By better material, we work faster, and that gives us favourable efficiency variances. All right, just one more, which you may think is funny, but still. One more could have been that the cost count was wrong. You know, people aren't perfect at preparing budgets, preparing cost cards. Maybe it was totally unrealistic from the first place. 4 kilos at 450. Maybe we couldn't possibly have bought it at 450. We made a mistake. We should have budgeted on spending 460, and maybe the manager didn't do a bad job at all. So it could be simply wrong standard costs. Now, if that were the case, again, we don't know the reason here. These are suggestions. But if that were the case, you can't really blame the purchasing manager for spending more unless it was him who did the original costings. But we'd better change our costings for the future. Otherwise, we're always going to be spending more. Anyway, they're only suggestions. I'm sure you could add more, although I think they all fall into one of those categories. You know, in the past, people have said to me, "Oh, it could be because we're buying goods from abroad, and the exchange rate has changed, so the price itself hasn't gone up, but because of the exchange rate, it's costing us more." Well, fine, but I put that really in the same category. You know, it's out of our control, clearly, if the price goes up or if the exchange rate changes. All right, well, I'd love to say that's the end of variance analysis, but I'm afraid it isn't. There's going to be one more lecture. And the reason is that that exercise we've just done, they were using marginal costing. And of course, thinking right back to the first lecture, first chapter, they could have been using absorption costing. And so for completeness, and this is exercise 3, we're going to have to do the whole exercise again. I won't use the same example, but we're going to do the whole exercise again, but using absorption costing. But don't worry, it won't take long, as you'll see. Most of the workings are exactly the same, and we've done them, and I'm not going to repeat them. There's just a couple of things that change. I'll explain why, and I don't think they're too hard to remember. So, leave that there, but the next lecture, same example, we'll do an operating statement, but we'll do it absorption costing.